we are back on yet another seesaw day in these markets. Surely these gentlemen will try to talk me off my bearish wedge. Let's see if they succeed. I'm Ilya Spivak in San Francisco. That's Dylan Radigan in Milan. Mike Butler in Chicago, who looks happy and probably ready to talk me off my bearish wedge because I'm thinking and it's all good. Gentlemen, we have another little seesaw day here. The pendulum swingeth, and it swingeth in all directions, and we end up with nothing. Is the market looking for rallies to sell? Is that what's going on here? Or am I thinking again?
It feels like it.
Well, first of all, I'd like to say that Mike Butler has a charming smirk that is laden with unspoken information.
I saw the smirk. I am
and he should be granted the floor to make commentary.
Right. I'm excited in advance.
Aren't we all?
So yes and no. I think it depends on what you're trading. If you're involved in the nuclear energy that powers AI, then you're doing just fine. Or if you're a bullish gold and silver, which will never go down again, then you're doing great.
Apparently not.
But yeah, it's fun. I was smirking because this morning when we were up 70, I was literally just sitting at my desk. I'm like, this is the funniest market. It's the most predictable, funny market I've ever seen in my life. And then we went down 20 net. And I was like, ooh, we're crashing. Like everything's over. It's all done. But yes, we are. It seems like we are selling the highs, but we still end green on the days, at least the last couple. But
we ended down yesterday, but it was only.
I mean,
I don't think it counts.
No,
I think we'll call that unched.
Yeah, but some of the things that we call out all the time, looking at volatility futures. Volatility futures had like a 2-point contango where there was 2 points of a discount between the near term and the next term contract. Now we are looking at a flat curve. So the V, the X, and the Z are all in the 20 handle and change. And that's what we want to see if we expect to see these two-sided action moves continue. So I think that's great for traders on both sides of the market. And yeah, I think it's really just a lot of sector-specific moves. You had your chip stocks like AMD going nuts with TSM, NVIDIA, what have you. And then today you had just an explosion in products like SMR. And yeah, I think if you're involved in the hyper-specific chip AI nuclear energy sector, like I think that's obviously been doing well today. But yeah, I think we are certainly in more murky waters than we were a couple weeks ago. And it's interesting because we have basically 100% probability that we are getting a 25 basis point cut in 2 weeks and another 25 basis point cut in December. And yet we are more volatile than we have been since really April.
Which lends one to believe that rate cuts do not solve whatever the markets are concerned with here, or at the very least that they have so thoroughly priced them in. I mean, we're well north of 90% likelihood on both the October and the December cut if you look at the CME Fed Watch tool. So whatever speculative juice there was to have in speculating on rate cuts and saying, well, if this thing goes our way, and by that we mean it makes rate cuts more likely, that's a good thing. Risk on. There's a reaction function there to go do something with risk sentiment. To go say, well, on the basis of this, I'm going to go buy something or sell something or whatever. There's not that impetus, perhaps, in the Fed story at this point, if what we're looking at is this year. There's still this massive disconnect between what the markets think is going to happen next year and what the Fed is saying, but it doesn't look like anybody is really bothered to reconcile that difference here and now. That seems more like a let's look at the economic data kind of thing, and obviously with the shutdown, there is no economic data. So if there's no economic data, then there's nothing to speculate about beyond what's immediately in front of people's noses, and that part is so locked in at this point that perhaps the Fed story is just not a story. I mean, Powell actually said something of kind of substance yesterday, in the sense that he signaled that quantitative tightening is maybe months away from being over. Markets could have taken that as encouragingly dovish. They didn't. They didn't care. Mirren came out today and said a bunch of Mirren-ish things. Nobody cared. Maybe we're just done with that narrative until there's data and we can think beyond these next two meetings.
Might I offer a few comments in the spirit of the first principles analysis as it sort of aligns itself with modern parlance?
Yes, please, sir.
So let's work on base assumptions we can all agree to and take it from there. First and foremost, we're in some version of an AI supernova bubble / exuberance. Call it what you want.
Without
But
question.
it exists. Whether you believe in it or not doesn't matter. AI bubble / supernova.
I mean, that's just a function of numbers. We know
force.
this empirically.
So take that as a first principle of this market. Second first principle, the President of the United States is an egotistical loon bird, capable of saying anything at any time, specifically targeting China. Fair?
Certainly no shortage of cuckoo birding vis-a-/ the trade war situation.
I'm not saying he's wrong, but I'm saying the President of the United States is a fruit bird / loon bird with a specific hostility to China.
Certainly no shortage of aggressive statements vis-a-vis China coming out of the White House. This much is clear.
So two first principles. One, AI supernova / bubble. Two, president of the most powerful country in the world, anti-China fruit bird loon bird. Fair?
Fair.
So far, so good.
Three, worst year in 50 years for the US dollar. And I don't know what the metrics are on gold, but I got to figure it's one of the best years, if not the best year ever for gold. So it's an anti-fiat year.
I would say that story ended in July, because since July, which is now some amount of time, I mean, it's been 3 months. I mean, that's not nothing.
2 months.
That's not nothing. But the dollar bottomed in early July. We are now in mid-October.
I'm less dollar focused than I am gold, silver focused.
Yeah, gold and silver, to Mike's point,
Gold
apparently
extravaganza, sir.
Extravaganza. They apparently could not care one iota about anything. They're just going higher.
So I've got a gold extravaganza. I've got an AI supernova / bubble. And I've got the president of the most powerful country on the earth as an anti-China fruit bird loon bird.
And by the way, in the tradition of anti-China birding situations, going back to not just even the first Trump administration, but to some extent Obama and Biden, because a lot of the steps taken, for example, against Huawei, against ZTE, that kind of set the stage for what then becomes this. It's been coming.
What's been coming precisely?
A more combative stance against China, as inspired by China's more combative stance under Xi Jinping.
Make it a referendum on the behavior of the American president. We're going first principles. AI supernova / bubble.
Yes.
China-US rhetoric / policy, sort of heated.
Hot heat.
Hot.
Yeah.
Fiat currency / metals enthusiasm at an all-time high.
Without question.
Fed in a rate cutting cycle, to Mr. Mike Butler's point.
Mm-hmm.
So let's just stop there. Is there any other first principle that either of you think that I'm omitting from this proposition? That's a sort of an organizing, unequivocal, undebatable, indisputable fact of the current market dynamic.
We still, I would say, have a war in Europe that shows no signs of.
Don't care.
I mean, it exists.
With all due respect, don't care.
It exists.
Irrelevant.
I would say that the non-response to the ending of the other one in the Middle East would suggest that indeed, yes, it doesn't matter. Nobody cares.
I mean, in the scope of, if we're thinking purely a market, a sort of satanic, inhumane, market-based analysis, the AI supernova / bubble must be acknowledged. The heated China-US rhetoric must be acknowledged.
Yes. If the non-response to the ceasefire in Gaza is any indication, then the Russia-Ukraine thing is not even good for a day's worth of risk.
So it's not in the first principles, it's an adjacency. But the other first principle is, to both of your points, highest level of intraday market volatility since April.
Yep.
Right? We've got
to be sure
prone to these big sell-offs. It can get crazy, it can get wild. You can get these.
We're seesawing in crazy ranges.
So you got a ton of vol. You got a lot of China-US tension. You got an AI bubble / supernova. And you got this gold mania / fiat skepticism. How about if we just use
the only thing that I would take issue with there is the fiat skepticism, because bonds are going up in this environment, as is the dollar.
So then how do you justify, so again, and I don't disagree with what you're saying, and listen, I'm long the dollar, so I'd love for you to be right, but how do you express an opinion of the gold euphoria, if you will?
In my
not a fiat-based,
in my view,
thing.
What gold is doing is much linked to what dollar and the bonds are doing. They're just doing it better in gold, because gold answers not just the anti-risk, we want a haven, we want to park our money someplace that isn't stocks kind of a dynamic, because it does, to your point, have this anti-fiat thing. But it's not enough of an anti-fiat thing to actually inspire fiat, because fiat is in fact going up. So money is going into places, I would argue, that reflect both the uncertainty of the moment politically in the US, because first of all, we're sparring with China. Second of all, the Supreme Court is due to rule on the lion's share of these tariffs and whether the president can even do them. And that's maybe weeks away. So it's right here, that ruling. And there is clearly this AI thing, which for whatever reason has produced a very steady, very aggressive rally. And now, for whatever reason, the markets seem to think that things are kind of at a price level where they're having a hard time continuing to go higher. Are they fairly priced? Who knows what that even means? As Chair Powell would say about the neutral rate of interest, we can't know where it is. We know it by its works. So we don't know if the stock market has already reached peak or fair value for however much AI hype there is. We know it by its works. It hasn't managed to continue to rally. And Friday was a massive washout. And NASDAQ has been the leader on the downside, despite this idea that this is somehow motivated by the US-China trade war. The Russell, which might be more vulnerable cyclically to that kind of an economic threat, has actually outperformed. The NASDAQ has underperformed, and it's probably the most insulated because it's full of rich, big tech, which is probably the most insulated from China risk, generally speaking. And so with all of that in mind, you get the sense that the market is not so much selling for trade war reasons, so much as the trade war is just another thing in this bucket of we're at record highs. There's these risks that you've, I think, absolutely rightly identified. Let's lighten up. The destination then for capital to go as people lighten up has been the precious metals, the dollar, and bonds. But the precious metals have this added kicker that if the US goes full fruit bird, you're not in the dollar and bonds. So it's not so much that people don't like the dollar and bonds, it's that fiat has this added cherry. Or metals, rather, have this added cherry. And so they're outperforming.
You have to ask yourself, though, Mike Butler, what exactly is a fruit bird?
You do. You do.
That is a great question. That is great. But yeah,
the president of the United States, who is an obvious fruit bird.
I mean, I've been trading and looking at gold for over 10 years, but this is the only time where I've felt like it's very clear that the public consensus is the safest thing to invest in right now, even into this massive rally, is something like gold or silver. To all of your points. So
yeah,
and we keep bringing this up. Like, how many times we got to say it? IV rank at 84, implied volatility only at 20%. It's a joke. It's crazy. Like we had 2 week periods, two 2 week periods where we had a 40 point rally here and another 40 point rally here, and we're not getting another 40 point projection for another 200 days. So like this is the biggest implied volatility blowout I think I've seen in consecutive weeks, months, probably ever. So like it's just very interesting that the demand is so high for this that the markets can't even price implied volatility correctly because it's a gold ETF or gold futures. It's just it's an anomaly that I haven't seen before, I think, is the right way to put it. Outside of like your standard squeeze to the upside for your, heavily shorted stocks that get talked about on Reddit threads. But yeah, it's wild.
But I mean, if you're going to go back to the first principles, AI supernova, China super rhetoric without reference to birds or fruit.
Yeah,
metals mania. You got metals mania, China heat, and supernova. Let's just take those three. Make it real simple. Sort of that there's two perspectives on that. Like if you accept that those are the three first principles of the market: metals mania, China heat, and AI supernova. And you can either be long all three, long gold, long the Mag 7, short Nike, I guess, short the FXI, long, US domestic auto parts manufacturers, whatever the manifestation of the China heat trade is. Or you can be short all three. In other words, if the vectors around which opinions are formed are either in agreement with the supernova, the China heat, and the metals mania, or in opposition to, I think that the most interesting question becomes sort of how do you posture yourself as a trader, either in alignment with those things, in opposition to those things, or in some version of neutrality to those things that sort of harvests volatility or time or whatever it is. I mean, I say this for the benefit of the audience and also for my personal self-interest. I don't know what to do because I'm just as inclined to stop thinking and get long gold, get long the Mag 7 and call it a day, which probably is the right decision based on history, or to do some thinking, get short gold, get short at least Nike, maybe some more China adjacent names, and just hold no position in the Mag 7. I just think we do ourselves a disservice not to observe the actual sort of the core pillars of the entire market dynamic right now, which seems to revolve around those three things, lest you disagree.
I mean, in my mind, You don't need to make a decision that says, I am voting for continuity of first principles or not
Or
continuity.
opposition thereof. You're saying I
Yeah,
don't have to have an opinion on those three dynamics.
that's right. I think in the spirit of not thinking,
I love that.
the not thinking here isn't so much as to say, oh, well, I'm going to not think and assume these things persist. The not thinking, I think, lends itself to saying, I'm not even going to have an opinion. I'm going to let the price action have the opinion for me.
I mean, how can you do that in the look at the market since Friday?
I think if you look at the S&P,
price
for
action
example,
tells you to call a psychic and depends on the hour. I mean, we're in a full like schizo. I won't insult schizophrenics. We are in a market that is directionless and psychotic.
I think if you look at the S&P here, in particular, as a kind of generalized barometer of overall risk
Fire it up.
appetite, catch-all, whatever.
Sure.
I think what you see here is fascinating. It's fascinating because the price action is telling you very clearly where its head is at least vis-a-vis the first principle that we are in an AI supernova, which I think is clear. If we were in the kind of blinding supernova that we've been basically since April's lows, the market would be inclined to buy every dip. And we've seen that clearly. Whereas what we've seen since Friday's sell-off is the market is inclined to sell every rally.
That's why I bring up the second first principle, which is the fruit bird principle.
Right. But I think in our analysis of fruit birding as a catalyst to what we're seeing, I think one of the most critically interesting bits is that the underperformer index in all of this is the NASDAQ of all things. And so it seems like people are not.
Make sense? In other words, if fruit birdery is the new first principle adjacent to the supernova, doesn't it make sense that the most vulnerable index to the birdery based on fruit would be the NASDAQ?
Well, so, and this is the thing. Why are people put off by the fruit birding? Are they put off because they think that there is an economic risk? Or are they just saying this is erratic and a good excuse for me to take money off the table in the place where it has been the most concentrated?
But also just elevated uncertainty without judgment on anything.
Exactly. Exactly. And so in my mind, what we're watching here, just looking at the price action alone, just what the prices are saying, they're not saying to me that people see an economic risk in a US-China trade war as such. What they're seeing is a reason to go sell where they've been overexposed, which is the supernova. And
the supernova is the most vulnerable to the China heat.
Without getting not for economic reasons, but for speculative exposure reasons.
Or speculative exposure due to elevated uncertainty. And the greatest beneficiary.
And people just don't want elevated exposure.
Is metals mania. They're all kind of correlated. As uncertainty comes up, the supernova becomes more volatile / vulnerable to sell-offs. And metals mania actually takes on more momentum. I'm only going through this sort of rhetorical exercise in a genuine effort to find a rational trading thesis.
And I think this is where the rational idea comes.
What am I doing here, pal?
Well, so I think this is where the rational idea comes. If we take a look at the NASDAQ here, which Mike has up helpfully, we can put a horizontal line through this chart at give or take 25,000. And we get a very clear line in the sand. And we've tried to get back over this line in the sand, which was resistance, became support, got crashed through like a hot knife through butter on Friday.
Or like a
We've-
butter knife through hot butter. It's all
or
good.
like a butter knife through hot
Or like
butter,
a fruit
or
bird carrying a butter knife that is related adjacent to hot butter.
I think that's probably the clearest example here. And
I'm just
so,
trying to make Mike Butler smile. Anyway, I
and
got
so you look at this and you go, okay, well, every attempt to undo the bloodletting that was Friday has failed now for 3 consecutive days. This is telling you something, and that it's concentrated in the NASDAQ and not in kind of growthy areas of the market. That tells you something too. Because if the trade war is a growth risk, the price action isn't showing it. The price action is showing the trade war is an uncertainty catalyst that people are using as an excuse to divest from those things where they've been heaviest. And so it's
But
so
let's assume we've got a fresh marginal dollar. That
yes,
you've got $1, Mike Butler's got $1, I've got it's a new day.
yeah.
New day. And we walk into this
I'm
market
shorting Nasdaq
more than
and
long
buying dollars.
more than long. So you're short NASDAQ, long dollar. What about the gold?
I don't touch it.
Nothing doing.
I don't touch it. I'm
Short
not standing in
NASDAQ,
front of
long dollar.
the locomotive, and it feels a little bit rich to buy, which is not to say. I mean, I've spent much more time long these things.
Or your long volatility by virtue of being short NASDAQ.
I think you get the exposure that you want, that you would have been looking for in gold, by not buying gold near the highs, but by instead buying bonds and dollars and selling the big indexes.
Selling NASDAQ by virtue
I think it's the same idea.
Spreads or by virtue of directional.
I think buying puts.
Really? Look at you.
I think so, because I think what you want here.
Gold.
I think, well, I mean, at least that's the way I'm exposed at this point.
Okay.
I don't think you want to make the bet that volatility is going to contract from here, because I don't think you know that.
You don't.
I think instead what you know is that it's probably going to like, if your bet is that this is the washout, then vol's going to expand.
Yeah. Okay. Mike Butler, what say you?
I mean, yeah, I think when you have big market washouts, the NASDAQ will always be a leader to the downside relative to the S&P, because at least the S&P has.
Would you buy, if I gave you a fresh dollar from my wallet on this lovely afternoon, $1, nothing crazy, don't get excited. Would you use it to short the NASDAQ?
No. I would.
You would not.
No.
Would you use it to buy the dollar?
Yes. I think
Okay.
for me, that's a safer or more predictable play.
More higher probability of profit, as they would say.
I mean, I think that's probably right.
Yeah.
And what would you use it to buy a bond?
No.
Not so sure.
No.
Would you use it to buy gold?
Yeah. I haven't seen gold go down once.
Buy gold and the dollar. You would buy gold and the dollar.
So I could buy gold.
Those things have been happening in tandem.
I could buy gold, and then tomorrow I'd have $3 or $4, and then I can buy the dollar.
And then you buy more dollars.
Yeah. But just
Step
from a
3,
very
profit.
Yeah, a very easy, just in case people don't realize how concentrated the NASDAQ is. Like when you think of an ETF or a market leading indicator like the NASDAQ, you have to always remember the top 10 holdings make up 53%, almost 53% of the total allocations of the NASDAQ. Like in QQQ,
Mag 7 is the NASDAQ base.
Exactly, right. So when you have anything that threatens the success of the top 10 holdings of the NASDAQ, you get a massive washout like we saw on Friday. This is the biggest intraday move to the downside since we've seen since the gap down when the poster board came out on TV for the tariff stuff. So
yes,
Liberation Day.
Exactly.
Yes. The man with the foam.
Exactly.
The original bird with fruit.
But
that, by the way, is going to be a great movie later. The man with the foam board.
The man with the foam board.
I thought you were going to say the bird focused on fruit.
Oh no, fruit birding, the man with the foam board.
Thank you. Thank you.
But yeah,
anyway,
to Ilya's point, if you're choosing something to get short and you're deciding between QQQ and SPY, it's 100% QQQ because you know, based on what I just showed.
But you won't do it with my dollar.
I won't. No, because I'm a perpetual non-thinker. Just buy every dip. Because
you'll have nothing.
Habitual. Whereas I am a habitual line stepper.
Yeah, because if we look at this chart,
I mean, that's quite a chart. Lay it on us, brother.
Yeah, I mean this is just the beginning of the AI supernova. It feels like it's a mature thing, but it's absolutely not. And for better or worse, I think these companies get bigger and bigger. They get more monopolized in their individual sectors, and eventually, somehow, the NASDAQ gets even more concentrated, if that's even possible. But yeah, I think I agree in the sentiment of if you think this volatility curve is going to flip into backwardation and all of a sudden 20 VIX futures gets to 30, I would want short exposure in the Qs because I know that the Qs are so concentrated to the sector that would have a big downside move if that were to happen. And we saw that on Friday, and we would see it again if we do get that volatility spike continuation. So it's nice because like other ETFs, you know that you're going to get a bigger move in QQQ versus SPY, and QQQ, even into this implied volatility expansion that we've seen since Friday, it's still only 25%. It's nothing. If you want to buy puts or do a diagonal spread, like you can get a pretty nice return on capital if you are correct. Like even going December, November, I'm just going to throw up a classic 20-point wide for $10. Like you can risk $1,000 and you can make $1,000. And even if you get a rally to the upside, you can move this 580 to 590. You can manipulate it however you want, but there's definitely asymmetric return to the downside or upside when you're dealing with a product that is moving in a big way, but implied volatility isn't reflecting that. And you can see that here in gold too. Like if you wanted to short gold through GLD, this is still low implied volatility. Even with an IV rank of 84, you're looking at 26% IV. And again, we've seen GLD go from 300 to 390 in the course of, let's say, a month. And that's a 90-point move. Where's the next 90-point move? You have to go all the way out to the Jan 2028 cycle. I think it would be 40 at this point in time. That's crazy. So yeah.
Are you suggesting that's old, Mike Butler?
No, it's the new 25. I think
the new 25. I appreciate that.
Yeah, but like just looking at November. Let's say you're looking for a quick reversal of this thing, getting into this relative to the notional value of the product. So if I wanted to just get 100 short deltas in GLD and have a 37-day time frame, if we look at the P&L risk graph here, we're basically looking at a stock rental risk graph. I'm putting up $2,800 to short 100 deltas or 100 shares of GLD, which would cost me or have a notional value of 38 grand. So you can get extreme leverage relative to the cost of this thing and still define your risk and protect yourself if it does continue to the upside. So I like zebras and GLD. I like diagonal spreads too, but given the magnitude of the moves we're seeing in GLD and SLV, I think a debit trade like a zebra to the downside, if you want to short it, makes a lot of sense because you can get big returns relative to the cost on a swift move to the downside. So,
and this is where the price action thing I think is the most critical for me as a not thinking toolkit.
You think because don't lie to us. I know you think.
I mean, I do, but I can't. There's somebody that commented on one of my my YouTube videos saying, knowing the macro is very good, but if you let the macro supersede the price action, you might get your head kicked in.
Sure.
Paraphrasing. the kicking in of heads. That's my parlance. But it's right. I mean, that's exactly right. The issue with putting narrative in front of the price action is how all of these people are out here screaming bloody murder about this gold move like it's some sort of dollar devaluation something, when all you need to do is open your eyes. The dollar hasn't set a lower low since July. I mean, that's obviously not what's going on. Bonds are up. If there was really a dollar-based asset devaluation thing that was going on there, if people had lost sovereign confidence in U.S. assets, bonds would be cratering.
They would call it the debasement trade in the
right. This chestnut. If that were real, we'd be in early April where we saw it. We saw the dollar and we saw bonds and we saw stocks going down at the same time. And it was a sell America kind of sovereign risk thing. We know what that looks like, and it's not this. So the problem with letting narratives define what you think, absent the price action, is you can twist yourself into some pretty ridiculous arguments that don't survive contact with reality. And so when you look at, I think, gold, yeah, okay, it's gone up a lot, but as we've clearly learned, nothing in the world says that it can't keep going. So you might be queasy about buying it here because it's gone up so far. I know I am. But, and I've been long it and silver from most of the year. Where I've taken positions, they've been on the long side. I'm not attempting to sell any of these things. But I'm out, and it's kind of dicey to go buy it here. It feels dicey. But I think in the spirit of looking at the price action, you got to get a reversal signal on the chart, and then you can go shopping for a short. And that short might still be wrong. I've learned that clearly every time that there's been a downtick that I've looked to sell in stocks this year, absent the February to April sell-off, which obviously worked. It hasn't worked. Thankfully, I've had other positions. I'm not only doing one thing. And those have worked more than this has not. But I think you need a downtick, and gold just has no downtick. There's no resistance level against which to even evaluate risk. We had a level like that a few days back where last week, if memory serves, on Thursday, we had a big washout in gold, but it was a one-day washout. But at least that high told you, okay, if this is the high, and that's the last red bar you see here, if that's the high, if we're going down from here, you at least have a point of resistance to say, okay, if you go above that high, then no, it's not a top, the move is invalidated, get out. And that's your risk management framework. Over the past 4 days, you don't even have a downtick. I wouldn't short this until at least there is a move lower to tell you, here's a potential top, maybe.
So might I answer my own question?
Oh, of course.
Not to disagree with you
A proud tradition.
not to disagree with you objectively and directly. And baselessly, I might add. But I would short the living hell out of gold.
Here or pending some sign of weak behavior?
Right now.
Okay.
It's an absurdity. It's a preposterity. It is a comedy. Are they kidding us? Look,
this is where thinking gets you.
Different issue. This is why I don't have as much money as I should, but that's a different issue. I'm not saying that it's proper.
I mean, I agree. I agree.
I'm just
I have
answering my
been
own
known to
question.
think as well,
I thought he was saying
to
he'll
my
buy the
own
dollar.
to my own detriment.
He won't sell gold. He won't sell the Nasdaq, but he's happy to use my dollar for the dollar. That's fine. I'm telling you, short the living bejesus out of gold. Are you kidding me with this thing? I mean,
There will
come.
certainly be a day here soon.
I mean,
Unclear when, but there will be a day here
I
soon
mean,
when gold
structure
rips
something for me.
people's face
I
off.
mean, this thing is going to get destroyed at some point. I mean,
Yeah.
come on. First
Yeah.
and foremost.
Yeah.
I mean, from what level, with what instrument, God only knows. But for the love of all that is a fruit bird, gold must go down in a big way at some point. I mean, catastrophically.
Yes. Yes. I think that's the case. I think
I also
think we are going to have at some point.
Just to complete my answer to my own question,
Yeah.
I love long the dollar. I think we could all agree to that. You agree to
Yep.
that. Mike Butler agrees to that, which probably means it's wrong. But anyway, we have consensus on that one thing. And I wouldn't short the NASDAQ because I believe that the heated rhetoric of the president and commander in chief is less inclined to support anything that's NASDAQ negative, but is more inclined to support something that would be FXI or Aussie dollar or China adjacent negative. So short gold, short China, long dollar would be like my fresh US dollar trading events of the day.
So my question is,
sounds like what you want to be is short the Aussie dollar because what that takes together with it is a short China, long US dollar kind of a bet.
Doesn't take advantage of my short gold sentiment, but yes.
Gold is kind of on an island. If you're going to short gold, you got to short gold. Now, Australia is a big producer of metals, obviously, but any kind of sense that it is a proxy for metals is obviously wrong because it isn't doing what metals are doing. It's doing what stocks are doing, which is to say falling since last week. So in the sense that the Aussie answers at least two of your points here, I don't think it addresses the gold one. I think if you're gonna go sell oil or gold, you got to kind of do that there because those things are kind of off on their own thing.
Mike Butler, what?
That was my question: is if you want to get long the dollar, which pair would you utilize, or what is your favorite few pairs that you would utilize? You brought up the Aussie dollar,
Aussie, Canadian dollar. I think euro.
Come on, help a friend with
euro, yen. I don't think the pound is great at the moment. It seems to be a little bit more supported over the past 24 hours. I'm short it also, but if I wasn't putting it on, like if I didn't have exposure there already from higher levels, I wouldn't be putting it on now. I like selling the yen here. I like selling the euro here. I love selling the Aussie here. And I'm in all of these positions already. I don't want to get too huge. Buying the dollar against the Canadian dollar also looks pretty good, although I think the Aussie might be a little juicier given that it's China that we're fretting about here, and that's obviously a direct line. So in my mind, you could short the euro right here. You could short the yen right here. You could short the Aussie right here and have pretty good risk reward on all of those.
I just shorted
What about my short gold? What about short gold? Come on, short gold.
I need a downtick. I need a thing. So my biggest kind of lens on everything and for all time is risk reward. Does the bet make sense? Does taking the risk make sense relative to the reward I'm looking to get? There is no way to calculate that in gold until you have at least some kind of a swing high where you could say, okay, if it goes above this, I'm wrong. And that's my risk. Now, how far do I think it can go relative to what that risk is? Obviously, it can go down a lot from here.
Yeah.
So I just need a swing high. Give me a swing high against which to benchmark, and I'm there.
Well, the good news, Dylan, is you can short gold at higher prices tomorrow, most likely. But
thank you, my brother.
Well played, sir.
I did just short the euro dollar. So the nice thing about the tastyfx platform is these are continuous currency pairs.
I love it.
And shorting the euro dollar means you're shorting the euro, getting long the dollar by proxy. But the really nice thing about this position is if we zoom out on the daily chart, we are near highs, but the swap bid is a positive number, which tells you that regardless of your trade size, if you hit the bid and you short this thing, you are getting paid every day to hold this position. And it's
You're
not
earning positive carry.
Exactly. So it's not a huge number, but it is a nice thing to know, like, okay, I want to hold this short position. And the longer it's not working out for me or not getting to the point where I want it to, I'm at least getting paid every single day as an adjustment into your account to hold that position. So I love when positions that I want to have on also offer a positive swap bid if I'm shorting it, or swap ask if I'm buying it.
Yeah.
As it's just like it's kind of like a theta decay component. That's the way I think about it, is like you have the static
in
delta.
the futures, it's very much like a theta decay component, because this same financing cost is built into futures contract prices.
Yep.
And the closer the futures contract gets to expiration, the more it sort of converges on spot, because the more time elapses, the more of that swap degrades out of the price. So if, for example, you wanted to kind of mirror something similar to this, and you wanted to give yourself the most positive swap, you could, for example, go and short the M6 contract, but F6 rather than Z5, and just give yourself more time to the expiration of that contract. You'd have more positive swap baked into the future. And so it would decay less in price than spot if it were going the wrong way, because you'd have that added component. So lest you think there is an arbitrage opportunity here between the futures and spot, there isn't. But spot lets you see transparently what that carry is. It's sort of separated from the price, but also spot lets you manage your position size much cleaner, and there is no expiration. So you don't have to worry about the contract expiring.
The Aussie dollar lets you be long the dollar and short China all in one trade.
That's right. And it lets you do that in sizes. If, for example, you thought, you know what, it's all cute, this thing, but either I've never traded FX, futures, or spot, or I don't know if this whole thing has legs, we're just going to buy the dip later. If you're concerned, rather than having even an M6 contract, which would be 10,000 currency units, essentially a micro lot or a mini lot, you could go lower than that in spot. You could go to 1K, so a tenth of the mini futures. So you could have this exposure be very, very modest and control risk in a very nimble kind of way, in a way the futures don't let you past a certain size.
Yeah, that's the beauty of the tastyfx platform embedded here, is like I like to trade in micro lot, like 5 micro lots or 0.05. And that position size is so small to where like I regularly forget that I even have it on until a couple days pass. And I'm like, oh, I should maybe check on this. You can also put in profit loss targets too, or profit targets and stop losses. But with position sizes so small, I'd rather do the profit target side and just let the losses run. That's just me. But
I have those levels in my head because I want to allow the markets to kind of fuzz around them, and I can make the call. But if you wanted to lock them in, not unlike, by the way, on the option side, the analog is doing a vertical and saying, I am going to lock in my risk reward to some extent and say, okay, I'm risking this to make that. I've locked in a 2-to-1 risk reward. As long as I'm right 30% of the time, and I'm locking in a 2-to-1, a 3-to-1 risk reward, I'm going to make money. I don't even need to be right half the time. I only need to be right a third of the time, and I'm making money overall.
Well, you're breaking even based on the math you just described, with all due respect.
If it's 2-1, yes. If it's 3-1, you're making money. And so if that's the analog, you can lock that in with stop loss and limit orders in the spot FX side and basically end up with the same thing. Obviously, execution, as in all things, is a function of market conditions, and sometimes you get fruit birding from various places, and market rules go out the window, but such is life.
Yeah. One cool thing with currencies and futures, if you're using futures options, is not always, but sometimes you have these particular time frames like we are now with the euro dollar, where both of these expirations, the 51-day and the 23-day, they both settle to the Z5 contract. So you have no issues. You have no issues if you're long one and short the other of actually being long one contract and short a different contract. Both of these options settle to the same contract. So all that to say, it will feel like a regular diagonal spread if you were to do it in like SPY or the Qs. So you can throw something on like this where you're taking advantage of the near-term implied volatility, buying some longer-term option premium here, and you have yourself a theoretical risk graph that looks very similar to, if I can click the right buttons here, very similar to, you know, the ones that we talk about all the time. And you can define your risk similarly. Extrinsic value, $1,000 trade, you can make 500 on the way down, and you can hedge, you can manipulate this position, the short option, if it continues higher. But yeah, there's a lot of futures contracts right now that are in this window where you've got a 50-day and a 23-day or around there that settle to the same underlying contract.
Yeah. Now, it'll be no secret to anyone, I think, at this point, that I am a big fan of spot for all kinds of reasons. And much of them have to do with what we've discussed here. How nimble you can be with your size, how much you can customize your risk reward that way, how liquid this stuff is even after the cash equity close. I mean, obviously, most liquidity is still going to be in the London and New York overlap. So from about 8 a.m. Eastern to about noon Eastern, where both of those markets are on at the same time, you'll notice that's the tightest spreads you'll see on everything, including spot FX, just because the sheer volume of activity. But these things are, especially the major currencies, the G10 currencies, even the G8 currencies, they're going to be very, very liquid, even in Asia market hours, even in European, like sort of early Europe market hours. So you can put things on very, very tightly spread-wise in small size and really customize your level of risk exposure for not a bunch of money to execute very easily.
Love it. Couple minutes left here. I'm going to ask you the same question I always do, or try to. 1 day, 50-point move into SPX. The rest of the week through the 17th, 70 points. Where are you going to hang your hat? Inside 70 points to the upside or downside, or outside, upside, downside?
Outside.
Outside down?
Outside down.
Ooh. Well, that's to be expected.
I think we're getting to regime change here.
So predictable, all due respect. So it's what you do.
It's what I do. I've been waiting for what we've seen since Friday all year long.
If you look at his cufflinks, one says outside and the other one says down. So I'm going to say inside up.
And I'll take that one step further. I'll say outside up.
Got to make a market.
Yeah.
Outside up.
Yeah. Outside up. We'll be back to highs by the end of the week.
The one universal consensus amongst the three of us, for whatever that's worth, long dollar.
Yeah.
Do whatever you want with gold. Say what you will about NASDAQ and the fruit bird.
Yeah, sometimes it's as easy as just, and when I say easy, I mean when you're trying to find trade ideas in this market, just make it simple for yourself. Just ask yourself, what do I really truly believe is like a layup? And then you just build your trade around that with defined risk or risk within your threshold and a long time horizon to be right.
Yeah. Makes sense to me.
Cool.
What exactly is a fruit bird anyway?
I don't know.
Somewhere in the vicinity of a unicorn. It is a mythical creature.
I thought it was somebody at 1600 Pennsylvania Avenue.
It could be both.
I'll ask ChatGPT, see what they say.
And with that, overtime is out of time. If you have any thoughts on the nature of the fruit bird as a real or mythical creature, by all means, let us know. We'll be back to parse this discussion in a mere 23 hours, but don't go anywhere because I'll be right back for Macro Money, where we're going to unpick the non-data calendar of which there is nothing and try to figure out if, in fact, this is regime change for markets and see if we can get some sort of a macro narrative out of the price action itself. So don't go anywhere. We'll be right back.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Can't get a better
And we have another seesaw day for the markets. We had all the opportunity, it would have seemed, to find a little bit more direction. We certainly tried, but the markets once again refused to find direction. There's certainly a lot of fire and fury. We end up with a situation where the markets certainly find a way to go to a lot of places, but ultimately not get anywhere. And what we're going to try to do here is figure out what's going on and what it all means. I'm Elias Spivak, head of global macro here at tastylive, and this is Macro Money. And what we'll do here first and foremost is we'll take a look at the way that these markets behave. We'll take a look at the price action as it presents itself, and then see if we can't figure out what all of this amounts to, especially in the absence of economic data, in the absence of the sort of usual catalysts that might have been the driving force here, at least from the macro side, and ask a very important question. Are we finally in regime change mode for these markets? Now, it probably behooves us to then define what this means. What is regime change? What would be regime change? And probably the most helpful thing in looking at that story comes from the price action itself. And we find here that we get a little bit of a pop for the risky assets, at least at face value. S&P up almost 0.4%, NASDAQ up 0.6%. Decent showing in the bonds world. So not really going anywhere on the 10-year, a little bit higher on the 2-year, so yields a little bit higher, kind of lending credence to the idea that this was a mildly risk-positive day. Dollar is a little bit lower against the euro, a little bit lower against the yen. That Bitcoin is down is an interesting kind of thing here. It has been the order of the day recently, and for obvious reasons, that Bitcoin has been a kind of stocks on steroids type of asset, where if it's risk on, then stocks are up and Bitcoin is up more, and if it's risk off, then stocks are down and Bitcoin is down more. That's not what we're seeing here, clearly. And so looking at this, then, we seem to have, just looking at the daily close, as a kind of disconnect when it comes to Bitcoin, but everything else seems to fall broadly in line. Gold and crude oil, of course, continue to do their own thing. Crude oil doesn't really go anywhere. Gold apparently only knows one thing in the current environment, and that is to go up regardless of market conditions. It is up another 1.5%. But it's really the stock market that is the most interesting in this environment. And it's interesting in particular because of what the price action seems to suggest and how it was that we arrived at these end of day readings. And in the service of that, let's first take a look at the S&P, and of course the NASDAQ is going to be basically the same story. The upshot of everything that we're seeing here will be largely the same for NASDAQ. And so we'll just look at this chart as a kind of stand-in for risk sentiment in general. And what we find here, and this is where sort of our thinking about regime change comes into focus, we see this pointed rally here from April's lows. So here's Liberation Day. This is when President Trump comes out with that foam board of diverse tariff rates that everybody immediately freaks out about and says, oh my God, we're going to have bilateral negotiations of every single one of these tariff rates. We're going to have an absolute nightmare of trying to figure out what the rules on trade are in this environment. Holy moly, sell. And overlaid with that, of course, all the issues that follow. If you have a holy moly level situation on trade, then you also have one on the dollar. You also have one on risk appetite and the economy in general. And so you get this episode here where bonds and the dollar and stocks all go down together because the concern is that what the tariffs will do, among other things, is undermine the role of the dollar as a reserve currency and as a currency of commerce, undermine then the capacity for the U.S. to pay its debts at reasonable interest rates, and thereby sort of undermine the bonds, on and on and on and on. But from April, once the White House saw that kerfuffle and said, whoa, 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 hold on a second, here's a 90-day pause on the tariffs, this is too much, we hear you, let's back up. Since then, we've been in something of a regime. That regime being clearly bullish. Higher highs, higher lows, and every time that we've had, let's say, a trend chunk higher, where the slope is about here, higher highs, higher lows, then we get a downtick, whereby this is different from, let's say, something like this. This is just a day or two in the wrong direction, but the trend is intact. Here, the trend is ostensibly challenged, but in short order, we find a bottom, it's bought up, and we just change the slope, and the slope becomes this. Same thing here. You get a downtick, and it turns into a change in slope, not a change in direction. What we find here becomes fundamentally different in that context, where we get the downtick, much as we had here, much as we had here, but rather than the markets buying the dip quickly and getting us back into whatever resloped up move we've seen, what we see over the past 3 days are repeated attempts at a bounce that are consistently sold into. And so every time over the past 3 days that the markets have attempted to find their way through the dividing line here, if we kind of guesstimate that there is something, let's say, ugly as that line is, that there is something here, let's do that better, that essentially defines where this turn looks to be. So if, for example, we were to say, well, here is a line in the sand, right here, where this was the prior high, we got over it to restart the up move. We've now faltered and undone that breakout. And so instead, we're left with now a move lower. And every time, especially today, that we've attempted to get back over that line, we have failed. And so what you find here then is perhaps a change of regime, whereas every sell-off before was a reason to look for a buying of the dip. What it looks like over the past several days is every rally has become a reason to sell into this market. And so obviously it's early days so far, but what the price action seems to suggest here is that maybe we have finally turned a corner. Maybe this market has finally exhausted its resilience. Now, why do we think this? Why is this not just a pause to digest? And incidentally, it might be a pause to digest. But let's consider some of the kind of adjacent things occurring here that color what we think we're seeing. First of all, here's the sell-off on Friday. And what we're looking at here is the Russell, the S&P, and the NASDAQ. And what we find is that the NASDAQ has underperformed relative to the other two. Moreover, the Russell has outperformed. So on net, starting with the session open on Friday, so at the top of this red bar right here, starting here, we find that the S&P is net down 1.1%. NASDAQ is net down 1.5%. Russell is net up almost 1.8%, which is a curious thing because if what we saw on Friday really was a truly kind of straightforward, as it appears, reflection of this concern about re-escalation in the U.S.-China trade war, which was, of course, the triggering headline. The president went to Truth Social and posted a bunch of combative things about a 100% tariff on China, kicking off November 1st because China has decided to put significant export controls on rare earths minerals. If that's what this was, then that's a concern about growth and a headwind to economic activity. Surely that is a more vulnerable kind of story for the Russell, where small cap, cyclically sensitive names live, rather than the NASDAQ, which is where cash-rich, big tech names live. And where we saw outperformance, for example, during COVID, when there was no global economic activity to speak of. Because those names are probably the most immune cyclically in the current environment. And the AI craze only helps in that direction. It's not about ROI yet. It's still about picks and shovels and building what AI will need. That's been the driving narrative here. So if what we're concerned about is a growth risk because of the U.S.-China unpleasantness here, one would think it's the Russell that does worst and NASDAQ that holds up better. And clearly that's not what we're seeing, which makes one think that this is not about what the impact of trade war escalation would mean as such, and more about here is a reason to de-risk and reduce exposure in the place where most of that exposure has been. Big tech. Obviously, these are giant nodes of market cap unrivaled elsewhere in the space. So that suggests that the markets are in a mind to be liquidating, and the trade war is an excuse, not a reason as such. We had a couple things on the calendar today. Of course, economic data continues to be on pause while this government shutdown continues, but we did have some comments from Fed officials, most notably newly minted Fed Governor Stephen Miron, the White House's contribution to the FOMC group. And what we see, that's me being charitable, by the way, and because clearly it's highly unusual that somebody who is still technically employed at the White House, if technically on pause from that, also serve on the ostensibly independent monetary policy board. Very unusual, as far as I can think, unprecedented. But here we are. And the comments are what you might expect. Current Fed policy is more restrictive than people think. So basically all of the counter to the Fed consensus that you might have expected is on display. Differences in policy views for Mr. Miron relative to his colleagues is more based on speed of cuts versus the destination. This is certainly accurate. That we're cutting rates is consensus at the Fed at this point. He's more sanguine about inflation because he thinks housing costs are going to go down, and that's going to take inflation down for everything in whole. And if that didn't happen, he'd be concerned. He's also saying that there's no evidence that tariffs are raising inflation and that arguments are based on prior trends. I think that's a very difficult argument to make because, of course, the data seems to suggest otherwise by a long mile. We clearly have seen that tariffs are a factor here in PPI numbers and CPI numbers over recent months. Goods inflation is at multi-year highs. I mean, that much is clear. So it's an odd case to make, but nevertheless, there it is. Also, renewed U.S.-China tensions increase uncertainty, so not surprisingly, the very dovish Mr. Mirren has found a way to look at this as a reason to justify more rate cuts, which is where he wanted to go anyway. Makes sense, and also no surprise. Once again, exhorting the Fed to be seen as non-political, which is curious given how Mr. Mirren got to where he got, but no real bombshells here. And looking at the pricing for Fed policy, you can see that there wasn't really any bombshells here because the market did not really take this to mean much of anything as it pertains to policy expectations. If we take a look here at what we have on display, we find that we're still hugging the high 90s, as it were, for policy expectations of a rate cut at the October meeting. You can see that much has barely budged either versus yesterday or even versus a week ago. We see something very similar for December. Obviously, as of Friday, we had a massive surge in rate cut expectations there. But even a week back, so even before Friday, we can see we're really anchored into the high 90s here as well. Now, a week ago, this was closer to 80, so not quite as certain. But after Friday, we're clearly convinced that this move is coming, and it's coming at this point as assuredly as markets really get about an event in the future where there is always some degree of uncertainty because nobody has a crystal ball. So what we then end up with is an interesting situation because whatever Mr. Mirren said here clearly had no impact whatsoever as far as sort of the brass tacks of policy expectations. And the disconnect for next year, that basically remains frozen in time. The market's still baking in 69 basis points in cuts versus the Fed's bet on only 25 basis points. And the markets seem unwilling to want to reconcile that for the moment. Probably makes sense because there's no economic data to speak of, and so you don't really have anything to hang your hat on to think a little bit further ahead. So no big changes here, and in that context, not surprising that rates didn't really go anywhere today. The 2-year a little bit fuzzy, but 2 years more volatile than the 10-year, so that's not surprising. But ultimately, nothing ends up running away this way or that, and that makes sense. If we take a look at the way that policy expectations have behaved relative to what we've been seeing in stocks, we're actually seeing this new dynamic here, which helps to make the case that we have some kind of a regime change because we're getting more dovish, and yet we are not seeing stocks find solace in that in any kind of a lasting way. That, of course, is a huge contrast between everything that's happened, let's call it, from about here, where stocks keep going higher, but the recovery in policy expectations after April's scare ends, and you get more dovish expectations coming alongside higher stocks. Well, now things appear to have changed course, and you get stocks getting, at the very least, stuck even as expectations get more dovish. So you're not really seeing that same uplift to sentiment. Meanwhile, the dollar continues to perform well. It continues to recover even as things get more dovish here. And so ostensibly the rebound in the dollar is not because rates are going to be stickier at higher levels, and that gives the dollar a greater yield advantage. Instead, the dollar seems to be gaining for other reasons, and I would argue for haven reasons, because this is happening, this rebound in the dollar, again, as stocks get kind of stuck. And so the dollar is rising as we get a kind of risk-off sheen to what's going on in stock markets. There's not much on the calendar, of course, over the next 24 hours because data is still on pause. We do get a bunch more speeches. We'll see if the markets decide to care about them, but policy is certainly not front of mind at this point. And apparently neither are earnings, because we get another big batch of bank earnings today, and there's a hodgepodge of responses. Ultimately, nobody misses. Abbott Labs comes in line at 1.3 EPS. The price response here, which you can see in the box, is a hodgepodge of gains and losses that seem to be sort of idiosyncratic to the names, but ultimately no unifying narrative and no immediate follow through to bigger forces here. As far as the way that this earnings season is proceeding, and this is the framework from FactSet, we see that the amount of reward that markets have been getting for positive responses is only about a third of the historical average, whereas the negative response to misses has been greater than the historical average. And so you do get that sort of risk-off sheen that does point to regime change potential. And so exposure-wise, what I'm doing here is I'm still holding long the dollar against the Aussie, the pound, the euro, and the Canadian dollar. On the spot side of things, I also have a short exposure to the Swiss franc and the yen. And I've taken some put vertical bets here against the NASDAQ and the S&P, because it does seem like we're struggling to rebuild back higher. And so perhaps, again, we are no longer in a mode to buy dips. We are now in a mode to sell rips. Adding into that bond exposure, bonds seem to be clawing higher in this environment, which is interesting, of course, because that means lower yields, and that's not helping stocks, which only helps to reinforce the narrative, whereas before it might have been expected to help them. So still have these call verticals in the long end via TLT, still have a put vertical in crude oil as an overlay on all of this, and yet another risk-off piece of the puzzle. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host usually with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.